that's sort of where like I start to get a little bit paranoid, where I'm like, okay, like what's happening is everybody's not only am I optimistic about this, now everybody's optimistic about this, and therefore everybody's assuming a bunch of stuff is going to happen over 2 years. That's actually going to take like 5 or 6 years. And that starts to worry me a little bit, because then that means like the short term.
Okay, I mean, look, you're saying that this worries you. You're saying that you're paranoid, but you're also like mega long, all of these things. So, in what sense are you that paranoid?
Hey everyone, if you have been listening to Empire, you know that Santi and I are fed up with unaffordable fees and frustrating transaction speeds that make the on-chain experience basically unusable. So the Arbitrum team reached out and they showed us the platform. They showed us what you can do on Arbitrum. Whatever you're doing, you can experience frictionless transactions at lightning speed on Arbitrum. So head over to portal.arbitrum.io and check it out. What's up, everyone? Before we jump into today's episode, I'm excited to share Empire's first ever security partner. Harpie is the best tool to prevent your wallet from theft in real time. Harpie is not just a security solution, they are a peace of mind solution. But don't just take our word for it. Harpie is the only wallet security solution that protected 100% of its users from attacks like the Ledger one in Q4, which was an off-chain signature attack. To learn more about Harpie, click the link in the show notes or visit harpie.io/empire. What's up, everyone? Before we jump into the episode, little plug for Digital Asset Summit coming up in London, March 18th to 20th. Tickets are pacing so far ahead of schedule that we had to decrease the discount code. So instead of Empire 20, it is now Empire 10. Head over to the website, Digital Asset Summit, London, March 18th to 20th. Use code Empire10 and get 10% off your ticket. See you in London. What's up, everyone? Welcome back to Empire. We have our two favorite guests on the show. We've got Haseeb and Avichal. We've got 4 guys in 4 different time zones here. So yeah, welcome back to the show, guys.
Good to see you.
Thanks for having us.
Yeah. Haseeb, you gonna bring the energy?
I am going to try my best. It is early morning here in Singapore, but you know, whenever I'm here with Avichal, we always have something to fight about. So I think it'll make it work.
Good. Well, I'm excited for some beef here. I think, all right. So last time I had you guys on, we were talking like kind of mental models for investing in crypto. It was about maybe 7 or 8 months ago, heart of the bear market. And you guys basically laid out your kind of bull case for why you guys were excited, still excited. And what I would say is the heart of the bear. And now I think consensus is that we're back on, maybe beginning of the bull. So I think maybe that's the best place to start. Haseeb, if you could maybe kick us off, and then Avichal, I'll ask the same question for you. Like, what is your framework today for where we're at in this cycle?
So, you know, bull market, bear market is fairly difficult to quantify in crypto. The reality is that if you look at the last year, like 2023, I think the lived experience of most people in crypto is that 2023 was this year of contrition. It was a pretty difficult year. Like things were pretty slow and icy, and not a lot of deals getting done, and you know, a lot of really challenging moments with, you know, the SEC coming after the industry, a lot of regulatory action. The reality was that if you actually just go look at the chart of crypto market cap over 2023, we were up every single quarter. Basically, things, if you just look at the line, it basically is just up and to the right, almost uninterrupted for all of last year. Now, basically, up until Q4, everyone was calling it a bear market. And I think the way in which in their mind, it was a bear market was just the vibe was kind of bear markety. And I think the totality of, hey, we're still feeling the FTX overhang. We're getting put on public trial. There's a lot of negative energy and attention on crypto, and that feels bear markety, and there's not as much retail engagement, right? And that, I think that's how people think about what it means to be in a bear market as opposed to what a price is doing. Q4 really feels like when the sentiment shifted. Q4 was when you saw, you know, the crazy Solana run up, ordinals activity, all the retail engagements start to come back, price action start to come back. And then basically Q1, of course, the Bitcoin ETF has driven a lot of the story for January so far. So my sense of where we are in the cycle, like you said, we're in a bull market now. I mean, if price isn't the indication, the retail engagement and the positive sentiment that you're seeing from retail, institutional investors, exchange volumes, flows, all those things are there now. So it's hard to argue that we're not in a bull market. I think the question is, where are we in that bull cycle? And I think most people, I more or less agree with the consensus. I think last year I was probably a little bit more out of consensus. Now everyone pretty much agrees this year is going to be a good year. There's a lot of positive catalysts. It's hard to really even see what there is to be worried about, because it looks like all the regulatory risks that we were scared of are really getting pushed back and minimized by just how much energy and consensus is being built from the institutional side and even the legal and regulatory side around crypto. So it feels like a really good year.
Avichal, maybe I would assume you agree with Haseeb, so I'll throw a slightly different question to you, which is if we are, let's assume we are, okay, back in this bull market. I agree with Haseeb. We probably started at some point in 2023, and now it's like kind of consensus that we're back. How do you position as a fund for being back on?
I think you just get more paranoid. Like, I think what's going to happen, like, the best time to invest is when it looks like a bear market and everybody's scared, and the founders that are coming in have some true conviction, and they, it's like, hey, I've been doing a PhD for 5 years, and I want to productionize my research. Like, those are the best people to be investing in. The opportunists tend to come out when it's clearly a bull market. I don't think we're in like peak bull yet, and so you start having to have your sort of spidey sense going a little bit more, and like making sure people are here for the right reasons, not to sort of milk it, and you don't want to accidentally end up in the next FTX. So I think you just have to be a little bit more cautious, actually. I will add, I think it's when everybody is on the same page that this is definitely a bull market, that I also think the market has a tendency to inflict pain. So while I agree that we're probably in a really positive sentiment, and I think we're probably going to be in a good spot at the end of the year, both in terms of market and also just building and shipping. It's just so much backlog of great stuff that's going to ship over the next 3, 6, 9 months, which are really positive catalysts. I also think that it's entirely possible that we're just over our skis a little bit. Like, the sentiment is too good relative to what's actually happened. I think that the ETF is a good example here. It's like, I think a lot of people's expectations is that the way that the first couple of days here have gone, the first week, which has got a couple $1 billion in, that's just going to scale linearly, right? It's just going to be now every week another $1 billion comes in, and so we should just be at $50 billion pretty soon, and that's not really how these flows are going to work, I think. And so I think a lot of the sentiment, when it gets too positive, people get over their skis a little bit, and then it needs to sort of pull back. And that's my guess for kind of where we are right now, actually, which is pretty typical if you look at prior cycles and stuff. Like, in this part of the pre-halving cycle, like it's very typical for people to get over their skis for some reason, and then it pulls back.
So one of the things, both of you traffic in private and public markets, perhaps Haseeb, you guys more so on the public side, but nonetheless, how do you think about, like, going back to what you said, Haseeb, of the indicators you're paying attention to as it relates to where we are in the cycle? And I appreciate you guys invest through multiple cycles, not just like a year horizon, but from a relative allocation of dollars, certainly has felt that private rounds have really ratcheted up. You're back to, like, the valuations are back up. The size of the rounds are increasing. The type of founders that are coming to the space are not just like the true crypto natives. How do you think about the relative opportunity cost of taking more duration and liquidity risk versus putting it in the public markets? It's also been a rally of have and have-nots. Like, Solana has gone up a ton, Ethereum not so much, but still prices are down 50, 60% from the highs. So, general question to both of you, how you think about, like, allocating dollars in this current environment.
No, it's the right question to ask. Not all of our funds have the ability to just go buy publics and say, okay, well, I like ETH here versus doing a private round. You do need to pick your spots in a situation like this, where you're right, there is a lot of catch up in the private market valuations, which had been lagging publics. I think if you look at, like, Q4 was probably the best time to be doing privates, just because privates had not caught up yet with publics. Now they've kind of raced back into line. And so I think, we're probably past the period where you're still going to be getting discounts going into the private markets. That being said, like, if you do take the view that we're early into this cycle, and I think it seems pretty clear to me that we are, one of the indicators I look at is how much is retail really engaged. We've seen a huge amount of institutional interest, right? The ETF has obviously driven a lot of institutional eyeballs and a lot of buying from folks who previously didn't have access to the space, or just had too many hurdles to actually get direct exposure. But if you look at, the barometer I like to use within the US is looking at Coinbase. So where is the Coinbase app on the App Store? Right now, Coinbase app, last I checked, ranks 30th for finance. In the finance category, it ranks 30th, which means, like, we are not anywhere right now. This is not like, if you go drive in an Uber, if you go see your barber, are they talking to you about tokens and what coins to buy? No, at least not my experience. So to me, I think we're very, very early into retail really paying attention and getting engaged. Now, that's not to say they will anytime soon. It could be a year, 2 years. Who knows? Maybe the last retail cycle is over. I kind of doubt that, but it's something you have to take into account as a possibility. But the reality is that this is so far mostly institution driven, mostly kind of smart money driven up till now. And I think once you start to see the macro environment shift, and once you start to see risk appetite really start to turn back on over the next year or two, that's when I think you're going to see a more broad-based participation in crypto. Even the meme coin activity, inscriptions, all the stuff that we're seeing around this huge engagement of meme coins, especially on platforms like Solana, in absolute numbers, it's still pretty small, right? If you look at daily actives on Solana, we're not looking at 5 million people who are buying this stuff. And if you look at that compared to what's happening on centralized exchanges, it's still a far cry from what we saw in 2021, 2022.
Which I think speaks a little bit to this idea of, where is sentiment relative to the underlying, right, fundamentals, like who's actually using this stuff and how much real utility is there and so on. And I think this is part of what creates the cycles in crypto is that the sentiment just gets so out of whack where we actually are. And everybody that has been paying attention is so excited about something like the ETF happening that took so long that I worry a little bit that we're over our skis right now in terms of sentiment relative to like actual progress.
I guess I'd push back there. So I think what you're saying there is sentiment. It's like a ratio of sentiment to fundamentals, basically. But if you looked at the last cycle, fundamentals didn't matter in the slightest, right? You have something like, I don't know, or even if you look right now, like Maker is spitting off, I don't know, what did Maker do last year? 100 million in revenue or something. Great fundamentals. Yeah, hundreds, right? Coin is not going up though. So Avichal, how do you think about like whether or not the best investments this cycle will come from fundamentals?
Well, I mean, here's a question, right? If you look at Maker's a great example because you might be able to look at the cash flow. I mean, the fully diluted valuation of Maker right now is 2.1 billion. So if you had a company that was making 100 million in revenue, not like net profit out to shareholders, would it be worth $2 billion today? I would argue it wouldn't be, actually. Now, there are reasons I think you could
not in
walk
the traditional public markets.
Yeah, exactly, right. So to me, that actually suggests that that there's some other reason that people are willing to value it as such, and I have my theories on why. One could be that there's a positive sentiment baked in. People are like, this is going to do so much more revenue in the future, and so the sort of growth rate that they're baking in could be that this thing's going to do $1 billion really soon, because that's how crypto works. Another could be that, which is one thing I hold, is like it's a longer conversation, but I think there's an argument to be made that network values for token networks will always have an implicit PE ratio that's much higher than public equities. And it's a side effect of who's participating in the markets. But where, if you have a bunch of people in Southeast Asia and Nigeria and West Africa and Latin America, and in these places you're losing 8 or 10% per year to the dollar. I mean, that's like ZERP on steroids, right? You thought like zero interest rates were bad, where there's just a bunch of money. Like, what happens if your money's losing 8 or 10% a year? Like, you need to get it out. Like, you need to get it into something, right? And so the way that manifests in a market then is essentially really, really high PE ratios. And so that could be what's happening. But I would argue actually, like,
you're talking about like a scarcity premium that will continue to exist as long as people don't have easy access to traditional capital markets in the US, like buying Tesla and Google, Easter.
Correct. Yeah. And so like one way like it manifests in the public markets on the US side is like you get these crazy multiples on a Tesla or a Facebook or an Amazon, because what you have is a cohort of people that are baking a really, really high growth rate into the future projection of what this company or this entity, this network can do. That could create a really high multiple. So 100 million from Maker could result in a $2.1 billion network value. Or the other theory I have is that it's a bunch of people all over the world who don't really have access to the US financial markets and don't have access to any good financial products. They don't even have access to dollars. And now all of a sudden they have an entity that is producing cash flow at $100 million, right? So there's any cash flow coming off of this thing in US dollar terms is better than them losing 10% in Argentinian pesos or 20% a year in Naira or whatever, their base currency is. And so their willingness to pay a very high, effectively PE for that cash flow is what then drives up these ratios. But in either case, right, like I think that's relative to the other opportunities that you might have, the sentiment is so far outstripped what you could do with that cash. Like if you're not a crypto fund, let's say you're a family office, or you're just a private investor, do you want to pay those kinds of multiples for that cash flow? And I would argue you don't, unless you have a lot of positive sentiment, right? So unless you sort of believe that there's going to be a lot of growth here, it's hard to justify those multiples, which is where I think the sentiment is sort of manifest. So I look at those numbers actually, and I look at that somewhat negatively. Like I know you're sort of saying that's like a positive indication. I sort of look at that as proof that sentiment has outstripped fundamentals.
I don't know if that's an indication that sentiment has outstripped fundamentals so much as that, if you look at, let's look at Maker specifically.
Mhm.
In the case of Maker, and I should disclose it that we're long Maker. I think so for one, kind of actually a point in favor of Avichal. The forward revenue that you're looking at is probably overstated because of the fact that we know that interest rates are likely to come down.
Yep.
So it's likely actually that the correct adjusted forward PE is going to be lower than what you're seeing on Token Terminal, for example. That being said, I think what people are baking in when they're looking at Maker is the fact that I don't know anybody who's not bullish on this RWA story, in the sense that it's very, very clear that stablecoin supply right now, it's kind of been stuck at about 130 billion, 130, 140 for the last, call it like year and a half. And it's very clear, like this is kind of a very temporary stopping point, especially as interest rates come down. There's going to be more and more cash that's find its way on chain, and it's going to get tokenized and stabilized, especially if we get some kind of stablecoin regulation passed. That's going to make it easier for people to get more comfortable interacting with stablecoins within the U.S., much less internationally. I don't think there's any reason to think that this is not going to continue as a trend. It's basically, if you look over the last 5 years, it went from something like 800 million circulating in 2018 to now being like 140 billion. That's an insane growth rate. And I think we had a temporary stopping point during a pretty horrible bear market and historically high interest rates. We're moving away from that pretty rapidly, and I expect stablecoin supply to start expanding now that we're kind of getting back into a much healthier environment. And I think Maker's going to be a beneficiary of that. So I think there are good reasons to think like, hey, there's some positive catalysts here, and Maker has a lot of downside protection compared to a lot of other things that you can be investing into that are a lot more ripe for disruption. Maker at this point is one of the lindiest things in DeFi. People argue that it's boring. It doesn't really capture a lot of beta. Sometimes the rest of the market's moving and Maker's just kind of sitting there, standing in the middle of traffic, kind of unfazed by all the other excitement that's going on. But I think there are very few things you can invest into that actually really represent the RWA narrative and actually have real cash flow denominated exposures to what's happening with respect to that market. Maker's kind of the biggest game in town in that regard, and I think it's a real force.
So I should also two thoughts. One, none of this is financial advice, obviously, from any of us. And you should not listen to random people on the internet. Anybody that's listening right now. So second, I should also disclose we're also a log maker. We also have we also own Maker. But I think what you're saying actually kind of proves my point, right? Which is like the reason to invest is not because relative to today's cash flows, the price that you're paying is a great price. It's that there's this reason to believe that in the future it's going to do really, really well, which requires a sort of set of assumptions about tokenization, about real world assets, about things moving on chain, about this being the beneficiary of all of those trends. And hence in 5 years or 10 years, some long period of time that you might have a good investment here as a venture fund, right? And so but to believe all of those things, I think you have to have extremely positive sentiment. Like if you weren't like extremely optimistic about the future here, about these trends, then you just wouldn't make those investments. Which kind of gets back at this point that like fundamentally it's like in the short term is sentiment driven, not fundamentals driven. And that has a tendency to kind of get over its skis. And when that happens, we got to be really, then as an investor, you got to get really careful, because then the question you're asking is like, am I being too optimistic about how quickly these things will happen? Because the tendency, especially for investor types or technology types or founders, is to underestimate how long it will take for things to happen. Like you have a tendency to be too early rather than too late. Right. And so that's sort of where like I start to get a little bit paranoid, where I'm like, okay, like what's happening is everybody's like, not only am I optimistic about this, now everybody's optimistic about this. And therefore everybody's assuming a bunch of stuff is going to happen over 2 years. That's actually going to take like 5 or 6 years. And that starts to worry me a little bit, because then that means like the short term.
Okay. I mean, look, you're saying that this worries you. You're saying that you're paranoid, but you're also like mega long, all of these things. So in what sense are you that paranoid?
Well, no,
You got to keep dancing while the music's on.
Well, no, it's because it goes back to, I think, the thing that Santi was talking about, which I often say, which is like people overestimate what's going to happen in 2 years, but they underestimate what's going to happen in 10 years. And so if you have like a 7 to 10 year time horizon, then you can sort of tolerate that volatility in the short term. But I think you have to sort of, to the investment question, then you have to be a little bit careful about like, are you are you overpaying in the short term, right? Like, are you actually paying, like there's people out there that bought ETH at 1500 and they saw it go up a bunch and then it came down a bunch and then it came back up, like how much money have they made on their like $1,500 ETH as of today, or like at the end of Q1 or Q2, right? It's been kind of crazy. So there is an argument, I think, too, that even if you think ETH is worth a lot of money in 10 years, and who knows if it is, that being disciplined about the point at which you decide to make that entry based on where you think the market cycles are and so on, like you can sort of factor that into your decision making.
One of the things I want to get your thoughts on, Avichal, obviously you guys put up and have produced for a number of years now this developer report, which I think is one of the most important reports and pieces of information that I look at to make investment decisions. I would love to transition talking about like Solana versus the EVM centric mindset. I mean, I think most VCs are way overexposed to Ethereum and have been caught off sides with Solana. I'm curious how you guys think about that, the Ethereum roadmap and your conviction on that working versus something clearly that we've seen consumer behavior in Solana, and you can actually see a low fee environment. So we'd love to get your thoughts on that. I think it touches on modularity and a bunch of other things that are hot now.
Yeah. Another disclosure, we also have a lot of Solana. And so, don't listen to me about anything. Yeah, it's interesting. I think on the report, there's a couple sort of takeaways, I think, for me. One is that an increasing number of developers are developing across multiple chains. And so I have to go back and look at the number. I want to say it's like 30% of devs are now writing code that ultimately will sort of straddle up, more than two chains, which is pretty amazing. And, when you zoom into that, what's really interesting, though, is that 80% of devs or so, I'd have to go back and look at the number. I want to say it's like 70, 75, 80%, somewhere in that zone, are actually writing code for at least one EVM chain. And so while you are seeing people write for more than one chain, what you are seeing simultaneously is a network effect around the EVM, and sort of convergence there. Not that dissimilar. I think a common analog that people will make is JavaScript, which is the EVM is busted in all sorts of ways, but these things tend to have a path dependency. So the internet runs on JavaScript despite all of the challenges of JavaScript. And that's kind of maybe where we are with EVM. It's like maybe these ecosystems will just have to use EVM in some form, and that has a real network effect. At the same time, what you see is that these ecosystems like Solana that are not EVM tend to have the most dedicated developers. Like they have the developers that are only writing for those ecosystems. And I think that's a really interesting sort of go-to-market strategy, right, for an ecosystem to essentially say, we're going to not have devs that then later take their code and deploy it somewhere else. We're going to pick devs that only write for our ecosystem. And yes, that's a harder place to start, but over time, that might be a higher retention strategy. So for example, there are these really great flow diagrams that we looked at where we actually looked at the code that's deployed on chain and where does that logic first show up. And so you can fingerprint that and you can kind of look at the flow of code across chains. It's in the back of the deck. They're beautiful diagrams. They're like, I want to turn them into like prints or NFTs or something. But what you see is that actually most of the code that's on ETH originated on ETH, but there is something, like 10, 20% of code that originated on BNB or originated on Polygon. And actually like 80% of the code that's on BNB came from Ethereum. So you're seeing sort of this like cross-pollination, right? But in effect, what that means is that there's a lot of people writing code in the BNB ecosystem, almost like a test net for ETH, right? What they're doing is like taking some code, putting it over there, writing it, and then bringing it over to ETH later, which is kind of fascinating that they're doing that. So it's not just ETH code being exported, it's other people writing code and bringing it back to ETH. But you don't see that with Solana. It's not like people are writing code in the Solana ecosystem and then porting it over to ETH after they figured out if it works, or vice versa, right? And that actually over time is like an interesting advantage. And so we tend to think these things are not going to be winner take all. There's going to be some sort of power law. And if you think that the biggest winners are worth a lot of money, then even the second and third and fourth place winners could do quite well and have their own ecosystems. And there's a lot of precedent for this, right? If you look at take something like social networking, which I think people think of as like a pure network effect kind of a business. Yes, you have Facebook, but at scale, you also got Snap, you also got TikTok, you also have YouTube, and then you also have regional networks, right? You have Kakao Talk in Asia, right? You have Vkontakte in Russia. And so at scale, you can actually have networks that are regional or bounded by communities that can also be really successful. So I tend to think that we're going to actually probably have way more alt L1s than most people would conceptualize today because of sort of the way these network effects will work over time.
Haseeb, how do you think about that?
It's a very interesting question. It's one that we've had to grapple with a lot. So we own some Sol. It sounds like maybe we own less Sol than he had a big smile when he was talking about how much Sol he owned.
But you own more makers, so we can count on that. Yeah.
We do. We do. Okay, that may be the indication of who owns what on a relative basis. Is how
the relative
claiming we owned it.
That's right.
Yeah, exactly. What's my view on Solana is that I think we may have crossed the period where you can start a new programming environment for your own blockchain. I think there may have been a critical period basically around like 2018 to 2021 where there was enough, like the space was inchoate enough that you could start from scratch and still be competitive in terms of development environment, auditing firms, hiring, all this stuff that has now increasingly solidified around a very small number of ecosystems. It feels like basically there's EVM, which is by far the dominant paradigm for programming. Something 9 out of the top 10 chains by TVL and by users are EVM based. So vast majority of it is EVM if you draw the pie chart. Second is SVM, which is Solana's virtual machine. Then you have WASM, and then you have Move. And after that, it's just basically non-existent. Now there are other programming paradigms that people have put together, but they have basically a rounding error of adoption. And I think we're at the point now where if you start a new one, it may have been true for Solana in 2019, but it's not true anymore today. If you start a new programming paradigm, nobody will join you. The costs are too high. Only an idiot would constrain themselves if starting a new company, starting a new paradigm, hiring a bunch of engineers, trying to get super expensive audits for some programming paradigm nobody knows about, hoping there are no bugs in the runtime, like the enormous amount of commitment that someone would have to make to betting that your new L1 paradigm is going to work against everything else that's out there, it's just too late. So my sense is that we're in the situation now where we've got sort of the Android, which is EVM, which it's kind of, I don't know, this may be a bad analogy because there's some other connotations between Android and iOS, but we sort of have the Android, which is EVM, which is basically everywhere, and the vast majority of people on Earth are using EVMs. Then you've got Solana, which is kind of this higher end, super high performance thing, but there's only one chain, there's only one home for it. Maybe there will be other roll-ups or something that are going to use the SVM, but right now it really kind of seems like Solana is the only game in town. And if you're building on Solana, you're kind of pot committed. And that's what you see from a lot of the Solana builders is that obviously there's been a lot of churn through the bear market of people who end up dropping out. But there was also no new people who came into Solana and started building over the last year and a half, right? Since the collapse of FTX, nobody in their right mind started building on Solana. Now you're starting to see people come back and some new renewed interest, seeing the retail engagement, seeing the price action, seeing the support in the ecosystem energy. But basically it's like, if you look at the projects that are all successful in Solana, they're all people who started during the FTX era and were willing to stick it out through the Valley of Darkness. And that's kind of what built the strength of that ecosystem was the belief and the confidence that people had during a time when no one else believed in them. So they really kind of had their hero's journey in forging that collective identity for Solana. And I give a lot of credit to them for having born through that. But if you look at a lot of the other ecosystems that are trying to play for that spot that Solana's playing for, the reality is that it's really, really hard for there to be multiple contenders for the non-EVM chain. I really think that right now, if you look at Near, you look at the Move chains, and we're investors in many of them, Solana is really pulling a lot of the air out of the room. And it seems to me at equilibrium, there's going to be probably one main non-EVM chain that sucks up a lot of the non-EVM use cases. And everybody right now is fighting for that spot. Now, to be clear, Solana is the front runner right now, but it's far from over, right? Very few of the non-EVMs really have that much going on in absolute terms. Even Solana right now, most of what's happening on Solana is people trading meme coins. There's some DeFi stuff that's like starting to work. There's obviously a lot of airdrop farming. There's a lot of infrastructure that people are excited about, like Jito and whatnot. But in terms of real mass market applications, most of what's happening right now is happening on EVMs, whether it's Binance Smart Chain or Polygon or Ethereum mainnet or some of these other platforms. And so I think the race is still very young. Price action, Solana has raced ahead, and there's a lot of consensus that's been built around them. But there's a lot of game left to be played. And so I think if you draw the line out over 5 years, I think there's still a lot of room for people to jockey for that position, to be that dominant non-Ethereum L1.
So, Haseeb, do you think the market structure is going to be like 80-20? Like it's basically EVM and one other big one, and then everything else is ultimately a rounding error? Or do you think it's more power law, like 70?
Basically.
Interesting.
I think it is going to be 80-20-ish
Yeah.
with EVMs and then like the non-EVM chain. And the non-EVM chain, it could even be bigger, right? It could even be like 30% or something. But I think of it actually a lot like operating systems. So if you think in terms of operating systems, I think in a way you can analogize the EVM to like Linux, right? And Linux is at this point the basis for the vast majority of computing. Mac OS is based on the Unix kernel, and there's just almost everything is just compatible with this thing because it's just the easiest thing for everybody to coordinate on. It's not high performance. It's not really designed to go fast or be good. It's just designed to be usable, and everyone kind of knows how to use it. So the paradigm is recognizable. Then you have, now if you're doing robotics, if you're doing hardware for a car or for something that really requires high performance, you will not use Linux. You will use some kind of real-time operating system. And a real-time operating system, it strips out all the nice affordances, all the common paradigms everyone knows about user space and kernel space and all the security guarantees and all this other shit, because it just needs to be really fast. You cannot have a robot or a drone get stuck in some garbage collecting, like, oh, we're sorry for switching from this kernel space to that kernel space and blah blah blah. You need it to be super high performance. In the process of that, you lose a lot of affordances. It's not very nice to develop for a real-time operating system, but it's the only way to get super high performance. There's a class of applications that are going to want this. It's not every application. In fact, the majority of the stuff that people seem to use crypto for, they don't really need 400 millisecond latency, right? 1-2 seconds is fine. If you're paying somebody, 1 or 2 seconds is fine. It's not really that big of a deal. If you're trying to do NASDAQ on the blockchain, 1-2 seconds is not going to cut it. So there's I think there are use cases just like there are with respect to operating systems that require a very different set of performance guarantees for which people are willing to eat the glass and take the trade-off. That's, I think, what in the long run, this whole system is going to bifurcate into. That's my thesis.
But why do you think it's operating systems and not programming languages or databases? Like, why is that
programming languages? I think because with programming languages, it's not. I mean, you can make the same analogy. It's just a little more tortured because of the fact that programming languages don't divide as neatly across use cases. Mm-hmm. A lot of the times, like someone who's doing payments, you can do payments in Python, you can do payments in C++.
Sort of. I mean, like you don't want to render a web page in like C, right? Like, I mean,
web pages are rendered in in
HTML,
V8,
right?
which is written in.
So, Haseeb, do you think L1s will divide across use cases? So you think there'll be use cases that are basically strictly like only possible on Solana, basically, and then there's use cases on the EVM, essentially.
I think at equilibrium, you're going to see the vast majority of value. If you think of it value weighted, not just, are people trading NFTs on Solana? Of course they are.
Sure.
Are people trading NFTs on everything? Yes, more or less they're trading NFTs on anything they can trade them on. But it's very clear, like you don't need everything that Solana has built to trade NFTs, right? It's obviously overkill for trading NFTs. You can trade NFTs on fucking anything. NFTs don't require high throughput.
I disagree. I mean, like the history of the internet would suggest that computing would suggest that that's not true. Like this is sort of reminds me of the like Bill Gates, who needs more than 64K of RAM or whatever his quote was, or 256K of RAM. It feels like actually the history of computing is always like the more infrastructure you throw at it, the more new use cases somebody figures out, and hence it sucks up all the infrastructure. Like, yeah, you might like you. I guess you might be. I might grant you, like, it's not clear to me if you need like a true real-time operating system to trade NFTs, but as a side effect of there being a bunch of people who have seen a wealth effect on something like Solana, who then go and trade NFTs, you now have like saturate the network, and therefore you have to like figure out how to get more throughput. Yes, and then 100%. Somebody comes up, and then somebody gets some new use case, and therefore the new use case saturates the network. Mm-hmm. So you enter this like flywheel, right? So
yeah, so I completely agree with you with respect to saturation, right? So that's why I'm grouping the EVMs as like a big blob, right?
Yeah.
It's clear the vision for how EVM scale is not going to be, we have Solana and then we have the big EVM, right? I don't think, even with something like Monad, which is a parallel EVM implementation that I'm very excited about, it's not going to be able to absorb every unit of demand that people have for interacting with EVM chains. It's more that I believe over time, there's going to be more and more opacity to the end user of where their money is going and on what chain it's being settled. And at the end of the day, right now, we are in the age of you are literally typing into your browser what protocol you want to use. Or like, fetch this using HTTP, fetch this using FTP, fetch this using Go, whatever, like a Gopher, the very, very old internet client. And that's where we are right now in crypto, where human beings are manually specifying these things and dealing, the reality is that, like, why is it that you as a human being are trying to figure out how to bridge across a protocol, or like where your USDC is, or all this stuff? Like, it doesn't require anywhere near your level of IQ to do this, right?
Arguably, it requires
right now you're handling,
man. I'm always paranoid that I'm like,
that's true. That's true.
Like the problem is actually the opposite. It's like it's too hard. Like,
yes, no matter how smart you are, the paranoia does not go away. That's what I'm saying. It's like, this feels like it should really be machine led. This should not be human beings doing this. But it is right now. All of this is completely transparent to us as users of all of the nitty gritty details of how money is moving around. But people are doing it. They're moving the money around, but in this very mechanical way. That is what I'm arguing is going to go away.
Wouldn't that then suggest that the percentage that you think the EVM share is, 80%, let's call it, is actually going to be materially lower?
Yeah. If
there's chain abstraction, right now you've seen, let's consider the number of users in crypto, whatever you're going to slice it, it is a microcosm. It is we're all beta testers. Chain loyalty is not going to be a thing. People don't have back bias when they're coming fresh into crypto. The next 100 million people will not even care about any of these chains we're talking about. They will care about, am I able to do stuff faster, better, cheaper, which is a threshold by which people start using the stuff. And so when you think about, I agree with you, you don't need a Ferrari like Solana to trade an NFT or send a payment, but you do care. And I think Solana may have a greater shot at attracting attention. And if you're already doing one thing in Solana, then you're probably going to end up doing most of your things, like by virtue of just aggregation theory. I don't know if you would agree with that. And so, like, my thesis is, why wouldn't Solana eat up way more into the EVM share today? Because you're seeing DeFi has been challenged. Like the number of when fees are incredibly low, it really has unlocked like this nonlinear consumer behavior already. So wouldn't that dictate that Solana could really become that, like the inverse, actually, 80-20?
Well, here's what I'd say. So when you actually have, this goes back to the very age-old argument about horizontal scaling versus vertical scaling, right? And Solana is basically kind of max long vertical scaling. Is if we just scale the fuck out of this thing, we'd be giant beefy boxes. The history of technology tells us eventually you have to go horizontal, right? Doesn't matter how big you go vertical. Eventually, if you want to serve world scale, you always have to go horizontal eventually. Facebook learned that. Google learned that. Everybody eventually learns you have to go. Even Stack Overflow, which is the poster child for, we were all running this on one server and, scaling is for losers. Now they have two servers, right? So like eventually you give up and you realize if you want to be internet scale, you have to go horizontal, right? And I think Solana recognizes this, that yes, we can scale the shit out of this relative to every other L1, but that does not mean there's infinite capacity for having a decentralized network of big beefy servers that can run all the compute that people want to on it. Eventually it will also get saturated, just like everything will get saturated, because blockchains are physically bound. That is the way it works. And so let's take that as a starting point, that every network is physically bound. Everybody's eventually gonna have to go horizontal. If we believe that, hey, there is actually a mass market use case for this shit. In that story where you are going massively horizontal, if you look at Facebook, right? So Facebook, how did they go massively horizontal? The first thing they did is they basically just did MySQL. Just lots and lots of MySQL databases all talking to each other, just like basically an off-the-shelf database, just scale it. Eventually they did Cassandra and all this other fancy stuff that was like really, really specialized. But the easiest thing to do is to just get the thing that's easiest to use, scale it out horizontally, and effectively load balance between them, right? The thing right now with Solana, and look, I give a lot of credit to Solana. I think it's a very, very interesting and dynamic ecosystem. The reality is that Solana does not have anywhere near the robustness of tooling and the safety that the EVM has, right? It's way better on performance. Performance, it's like 11 out of 10. On security, the reality is that I don't think we've even seen a major Solana hack yet. Why have we not seen a major Solana hack? That seems really weird, given that everybody in Solana is writing in Rust. They're writing in a super low level, unsafe language. All this stuff. Like, how many auditors are there for Solana? Like 3. There's not that many. There's not the same level of open source battle tested contracts. We don't have the same ecosystem of bug bounties and people who've been what's it called CTFs. We don't have that same ecosystem of security around Solana. Even the protocol itself, right? The protocol itself has never found a major bug. There's been things that fell over because of demand, right? Like basically the RPCs got hit, or there was just too much load and it sort of fell over because of load. But if you remember, EVMs have been broken many times, and the EVM has existed for like 7 years, and there's still bugs in the major EVM clients. Like we just had what was it? It was Besu. It was a little while back, and then we had Nethermind, which had a major bug in it as well. Almost certainly the Solana client has bugs in it. There's no fucking way that a code base writing something as complex as Solana does not have bugs. And the question is, why haven't we seen any? My theory of why we haven't seen anything happen yet is because most of this stuff is not open source, and it's just so complicated.
So I would challenge that, because that was my impression too. 2 weeks ago, I always felt like most of the projects were closed source. And there's a stat now. I think like the overwhelming majority of Solana projects are open source.
No, sir,
and this has changed drastically.
If you look at, I'm assuming you're referring to the DeFi Llama dashboard, which shows percent of open source versus closed source, right? Which has gone from 40% a year and a half ago to now 90% open source, right? I assume that's what you're referring to, because that's the only shareable number I've seen anyone ever share. That is a TVL weighted number. That is showing by TVL how much of the stuff on Solana is open source versus closed source that's in DeFi Llama's database. That basically is saying that there's a huge amount of liquid staking on Solana, and that stuff is open source.
I think it's probably, based on the developer numbers we have relative to the developer numbers the Solana Foundation publishes, I think we were off by about 2x. That was like the delta. And my theory is that we track only the open source devs, and the Solana Foundation is probably using like RPC calls, or like they have like endpoints that they're looking at that are like accounts. And so I think it might actually be pretty close to like 50-50 at this point. I historically had the impression too that it was a lot more closed source. But given that the delta between like the numbers we're seeing and what the Solana Foundation put out was like 2x, that suggests to me we're like probably close to 50-50 at this point. It might be like
we don't have to debate like open source versus closed source here, because I don't know, we all have different numbers here. But Haseeb, I think the next question I'd throw to you is, okay, let's say it is EVM. What is the EVM landscape going to look like, right? Because there's kind of the early like Arbitrum and Optimism and kind of like the first L2s. Now there's this new wave of like folks trying to parallelize the EVM, and there's who'd say and Monad, and this kind of next wave of folks working on the EVM. So what does that look like in your mind?
Yeah, so it's very clear that part of the reason why Solana has gained so much mindshare is because of their relentless pursuit of high performance. And everyone realizes that this is, every bull market, we see that this is the problem, is that we don't have enough performance. We need more scale, more DACA, more. And in this case, I think, Solana makes some really steep trade-offs in order to achieve that performance, right? And, I alluded to some of them. Obviously, we can debate the particulars of how much open source, closed source, whatever. But one of the things that you get from Solana because of its pursuit of performance is that the EVM was really designed to be a smart contract platform from the ground up, right? And it made a lot of trade-offs. Actually, I should take that back. It was designed kind of in a harebrained weekend, but it has evolved to become more of a focus on just smart contracts. If you look on Solana, for example, just to kind of drill in the point, and then I'll bring it back to parallel EVM. On Solana, if you go on Solana block explorers, you can't see contract code. Why can't you see contract code, right? The whole point of blockchain is that you don't need to verify, you can trust. Or sorry, other way around. You don't need to trust, you can verify. You should know exactly what you're interacting with. Even for the things that are open source on Solana, how do you know that the thing you're interacting with is the thing whose source is open? It seems like an obvious question. Well, on the EVM, it's trivial to do that. On Solana, it's not. Even the Solana, all the canonical block explorers, you can't see the contract code. You don't know what you're interacting with. You kind of have to trust that you're interacting with the right thing. Now, one of the reasons why that is that most of the Solana build process is not deterministic. When you are compiling shit in Rust, it's a non-deterministic compiler. It's not designed to be deterministic. If you want deterministic builds, they're slower. And compilation in Solana is already a pain point. It's slow. It's annoying. People don't want to eat the cost of doing that, at least not right now. And the culture doesn't demand it. So when you interact with things that are nominally open source on Solana, it's very difficult for you to actually even verify that the thing you're interacting with is the thing that supposedly is on GitHub. EVMs have solved this problem, and it's very deeply baked into the culture of the EVM that you can't get one without the others. Claiming something is open source, but not actually being able to verify in a block explorer that, yes, this is the bytecode that this Solidity code produces, that is the only way to actually be confident that, yes, this is the thing I'm interacting with. EVM gives you all of that. It gives you the interoperability. It gives you the guarantees about transparency and verifiability, not because of something intrinsic about the EVM, but because of all of the tool chain and the supply chain and the culture and the the audited code and the contracts and blah blah blah, all that shit. It's all already there. It's all already been built. If we started with Solana or we started with SVM, we would probably all have all that shit for the SVM as well. But we didn't. We started with EVM, and so therefore the EVM is just the most built out ecosystem for this. So now I think there's this relentless pursuit to, okay, if we take it for granted that the EVM is JavaScript, look, JavaScript sucks. It was a horrible language that also was written in kind of a cocaine-filled weekend by Brent and Ike, basically trying to ship something out as a V1, and we got stuck with it. We're just stuck. It was horribly designed. It was not really built for being the world scale language, but it's now the most used language in the world because most computers are basically glorified browsers now. It's all we do is just sit in browsers. And so JavaScript is basically most of what your computer does is just run fucking JavaScript. So JavaScript is super, super, super highly optimized. It is probably the most optimized language in existence besides maybe C and C++. And so because of that, the analogy you can draw is, okay, the same thing will probably happen to the EVM. And I've been waiting for a very long time for somebody to really seriously do this. And it's more or less taken until this year for serious contenders to try to do to the EVM what has long been done by Google and Mozilla to JavaScript, for that same process to happen to the EVM. And so if you look at something like Monad, for example, so Monad, it's not currently live yet. Say is also doing a parallel EVM, but my bags are in Monad, so I'm going to show Monad. Monad, what they're essentially doing is taking the sort of the modern blockchain design that has massively changed since when Ethereum was first developed, of separating execution and consensus, using something like hot stuff or more PBFT style, more modern consensus mechanisms, totally rebuilding the storage system. Right now, almost all the Geth chains, whether it's Binance Smart Chain or Polygon or whatever, that just fork Geth, their bottleneck is storage. Almost all the time, because Merkle-Patricia trees, which are the data structure for Ethereum, just fucking suck to read and write to efficiently from storage. And so they're basically designing their own database that only is optimized for storing and retrieving Merkle-Patricia trees. And all of this stuff leads to really, really massive throughput gains. And then the last thing, of course, so we talk about parallel EVM. I didn't mention anything about parallelization, because parallelization is actually a very small part of what leads to the performance gains in these new next generation EVM implementations. But they're also parallelizing. They're using block STM, which was originally created by Libra and later by Aptos and Sui, or co-opted by Aptos and Sui, to basically do like kind of optimistic concurrency or parallelization. A little bit different from Solana, more similar to what Aptos and Sui do in assuming that, hey, we can kind of guess, much more like what your processor does, is guessing which transactions or which computations can be parallelized. And if we get it wrong, okay, we rewind and then we just do these things serially. That's a very high level intuition for all the things that these new generation of EVMs are trying to do to massively increase performance and get, they're never going to be Solana-like performance because they're running EVM, and EVM is just a big constraint. But they're getting massively more performance than you can get just doing a vanilla, Geth type implementation.
So can I highlight a couple places where I think I just disagree with a bunch of this stuff that Haseeb was throwing out there? So I think one, it's not clear to me that the right analogy is the operating system. I tend to think of these things much more like programming languages and databases, because I think I don't know who said it, maybe Santi, but I don't think the end user 5 years from now is going to care that it's running on Solana or Ethereum or Near or Monad or some L2. They just want to like do the thing. They just want to solve a problem that they have. And it reminds me a lot of what happened with like mobile, or what happened with early internet. Like there was a time with mobile where, like, as an angel investor or as a VC or even a founder, you would go in and you would pitch, and you would pitch that I'm an iPhone app, and I look at all the new APIs, and I take advantage of the new camera APIs, and therefore I can do XYZ. And at a certain point, you just stop pitching that you were an iPhone app. You just went in and you pitched, and you were like, I solved this problem. And if at that point, like today, if you came into a VC's office and you're like, we're a mobile app that does XYZ, the VCs would look at you and be like, well, of course you are. Like, what if you're not a mobile app? Like, what are you doing? Right? Like, that's where all the users are. And so I think we're kind of on a similar arc here. And so 5 years from now, or 7 years from now, or 10 years from now, people just won't care what the database is that this thing runs on. And if we get to that world, it's not clear to me that that these distinct that the market structure will be 80% EVM, one, right? Like that's just, you can have a lot of fragmentation because a lot of different developers can choose to plug these components in different ways. Like you need one execution environment and one data availability layer and some other for settlement. And like you can plug these things together and the end user won't really care. And that might break the network effects, right? That might mean that you don't get power laws anymore. You get a high degree of fragmentation. Two, it's interesting that we think of this as EVM, right? Like that just happens to be sort of the nature of the compatibility that we're talking about. But actually underneath the EVM are a lot, Arbitrum is different than Optimism, is different than Monad, is different than ETHL1. Like, these are actually different chains in some sense. And that in some sense also breaks the network effects, right? It's different flavors of a thing that happens to be compatible and can talk to each other, but they're not actually the same thing. I also think that if it's true that the network effects are sort of at the technology layer, but not at the chain layer, what that means is like the real power in the ecosystem is at the layer of whoever has has either the developers or has the users. And I think it's going to be actually towards the users. And I think if like from that perspective, the real sort of question, the question that sort of in the back of my head is like, in 10 years, are any of these things even worth remotely what they're worth today? Right? Do you actually end up in a world where like actually all the value capture happens at like Coinbase, right? Because Coinbase is the place where you have to like fiat your money in, on ramp it, interact with a bunch of stuff, and it's on a phone. And like, who cares what chain it's on? I just need to do the thing. I need to move my money around. I need to get to my payroll. I need to like pay my creator friend like $10 this month for whatever service. And who cares like what service it's running on? And so I think there's actually an argument here that this is not going to be 80-20. I think there's an argument that actually even inside the EVM, it's going to be like 100 different things, and that the end user just won't care at all.
Okay, so let's take that for granted. Let's assume that we're in that world where there's total chain abstraction. As a user, I just have a wallet. I don't even know. It's not a Solana wallet. It's not an Ethereum wallet. It's a crypto wallet.
Yeah.
And the wallet figures it all out. It bridges. Yeah. Bridging is fat. Blah blah.
That's not even theoretical.
All like the friction's gone.
Magic Eden is doing this now, for example. Their new wallet just sort of like seamlessly switches between chains. You don't have to think about where your NFT, like, is it a Solana NFT or is it a Bitcoin NFT? I don't have to.
Sure.
Think about
Let's assume that. Let's assume that it's multi-chain. It does all the bridging. Yeah. It's super smart. Okay. It's like AI driven, whatever. Who gives a shit? So we're already there. Okay. We're already there. Yeah. It does not sound plausible to me that, okay, because we're there, because we're in that world where most consumers are interacting with this super smart wallet router app, that, like, let's take for granted that, okay, I want to trade. I want to buy a CryptoPunk. I want to move some USDC around, right? The way in which I move that USDC around, I think you're right. It's going to be, it doesn't really matter. It's kind of like Swift, right? It figures out what rails to take the bank transfer to go from here to there. It doesn't, that's totally opaque to me. If my friend is on Solana, they'll get the USDC on Solana. If my friend is on Arbitrum, they'll get it on Arbitrum, right? So there, it doesn't seem to me like there's going to be a payments-based monopoly per se, unless it's, focused around liquidity and large size. But for small size, it can basically be anywhere, right? Okay, fine. Now, for the most part, I'm going to want to interact with like a game, an NFT platform, a blah, 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 right? I want to interact with something. And the thing that I want to interact with, is it plausible that it's, okay, well, every single thing is going to live on Solana? Or every single thing is just going to be dispersed uniformly across blockchains such that everybody sort of has their own blockchain? Or do we expect there to be some agglomeration where there's like, yeah, I want to buy this NFT. And I go to OpenSea or I go to Magic Eden or I go whatever, and it just so happens that this NFT is on Solana or this NFT is on Ethereum, and it's still on Ethereum. Even 5 years later, it's still on Ethereum. If we ask the question, why 5 years later is it still on Ethereum? Why is it not on, okay, everything is on its own chain, and because it's all abstracted, nobody ever has to worry about competing for block space ever again, and all the blockchains have no network effects and all the fees have gone to zero. Why didn't that happen? And to my mind, the reason why that didn't happen is twofold. One is that there are real good reasons why you want atomic composability and tighter integrations between certain ecosystems, especially when it comes to like on-chain liquidity. There's a lot of stuff in DeFi that benefits from having the liquidity there on the same chain.
Mm-hmm.
But the second thing in my mind is the intolerant minority. This is a concept from Nassim Nicholas Taleb, where he talks about, I think the analogy he gives is kosher, like kosher food, in that most people don't give a shit about kosher. They don't care if their food is kosher or isn't kosher. If you tell me like, oh, these Cheetos are kosher, like even if I'm not Jewish, I'm fine, I'll just eat the Cheetos. But the people who are Jewish, they really fucking care whether this stuff is kosher or not. And so they are basically going to dictate that every piece of junk food is kosher, because you might as well just make it kosher so that Jewish people also eat it. So this concept is known as the intolerant minority, where a small number of people with very strong preferences end up shifting the entire economy in a certain direction if the cost is relatively low in order to satisfy those preferences. And this feels to me like the reason why NFTs are not just going to, shard into 1,000 different blockchains and be uniformly distributed over everything or over a cajillion L2s. Instead, I suspect the most valuable NFTs will still live on Ethereum. Why? Because there are probably going to be some hipsters in the year 2029 that are like, yo, I just believe that Ethereum NFTs are more valuable than the ones on Solana. And like, I still care about that. And maybe most people don't. And maybe most retail people, they just know Coinbase and, they don't even know what chains are. They just know crypto and they, their wallet figures it all out for them. But I still know. And I still really care. And like, there's something to me important about the Ethereum culture, religion, or Solana culture, Solana religion, etc. Even if someone goes and forks Solana and says, oh, Solana's so expensive now, there's all this competition for block space, it's too, state rent is too expensive on Solana. Solana's going to implement state rent. It's going to be expensive to store state on Solana. But eventually there will be another Solana and somebody will fork it and you'll say, well, why not launch your NFT on Solana too? And the answer is going to be, well, because it's not the real Solana. And some people will care about that, even if most people don't.
All right, I mentioned them in the pre-roll. Now I'm going to bring them up again. It's Arbitrum. Santi and I are really fed up with these high fees, and we're really excited to have teamed up with Arbitrum for the next couple of months on Empire. As the leading Ethereum scaling solution, Arbitrum now powers hundreds of decentralized apps across DeFi, perps, NFTs, gaming, and a whole lot more. The team has showed us everything in the ecosystem, both now and what's to come, and we're really, really excited about it. Arbitrum allows both daily users and developers to interact with Ethereum at scale with low fees and faster transactions. The way the team got me excited was through portal.arbitrum.io. So my call to action to you is to get started by visiting portal.arbitrum.io. Go experience on-chain like it was meant to be. For a lot of Empire listeners, your crypto is not just another number on a screen. It's part of your future. I know Santi and myself feel that way. Our security sponsor of this episode, Harpie, takes this responsibility seriously and is the only wallet security tool that shields users from both on-chain threats and sneaky off-chain signature attacks. If you've ever been in that situation where you're moving quickly, you approve something on-chain, you realize that the address might be a dubious address, or you're really hoping that you could take that back, Harpie has you covered. Harpie can redirect your assets to your self-custodied vault, ensuring they remain completely under your control, safe and sound. With Harpie's always-on monitoring, you're not just detecting threats, you're actively blocking and recovering compromised assets from malicious transactions before they can even confirm on-chain. Harpie is the only wallet security solution that protected 100% of its users from attacks like the Ledger one in Q4, which was an off-chain signature attack. So if you're serious about protecting your crypto investments, it's time to make the switch. Secure your wallet for free at harpie.io/empire. That's Harpie, HARPIE.io/empire. If you want it to be even easier, just click the link in the show notes.
I know it's early, but like, are you like, I see the stuff that's happening in Solana, and I've constantly updated my thesis. Now I understand like the question that I think is most important is like, why haven't we seen more hacks in Solana? I'm not sure it's because like, I agree Rust is like Move. Like Move is like actually probably a language that, we should be able to like, we should probably like, I would take a bet that Move becomes a more prevalent language just purely on a security basis. And so if you're JP Morgan, Visa, like, that matters to you. But still, like, I don't know, like I'm not hearing a very convincing argument as to why Solana can't like overtake EVM. And you hear time and time again from founders that are trying to like vampire attack in some capacity the EVM, and like, the current liquidity and users are there and the culture is there, but is it really like, I don't know, like you know, I still am of the mind of
What do you
earlier
mean?
today.
Is it really?
No. Like, what I'm trying to say is, as you think of like investing your capital and where the space is headed in a 10-year time horizon is where I'm looking. And if you extend and I know you extrapolate what's happening today, I just think a lot, like when you think about the scalability trilemma, you know, there is, I think, a threshold by which you reach in terms of sufficient security, sufficient decentralization that I think Solana has crossed. That the most important thing at that point is scalability, and fees being as low as they are in Solana, in my mind, is the most important driver that gives me conviction that Solana's share relative to the EVM is going to grow by by meaningful share over the next 5-10 years. And I'm not hearing a convincing argument from you that it's not. Okay.
No. I am not saying that Solana is not going to continue growing. And I'm also not saying that Solana doesn't have a very important place in the ecosystem, right? To be clear, and let me re-underscore this, because I think I may come across as though like I think Solana is going to die or something. Like, no.
Haseeb just doesn't want the intolerant Solana minority coming after him on Twitter.
No. Look, they already come at me all the time. It's fine.
Yeah, Mert has raised up his pitchfork at Haseeb.
Oh, many times.
We're bringing Mert on stage.
This happened last time with the Cardano people. Like,
Cardano's different. Cardano's different.
You learned your lesson with the Cardano one.
No. Look, the Solana team, like they know. Dude, I've been criticizing them for like fucking 2 years, but we still invest in Solana. Like we own Sol, we invest into a bunch of stuff in the Solana ecosystem. They know that it comes from a place of love because like we're long this shit because we believe that what they're doing is great. Like they're killing it. At the same time, like. Look, I think Solana is going to continue to grow because of the fact that this niche that they're going after is fucking massive. It's extremely important, right? What are you going to be able to do with super high performance? And I think in many ways, actually, I don't even know if it's so much about scalability, quasi-scalability in the sense of super low fees. I think actually low latency is the thing that's most important about Solana rather than the low fees. Low fees are a function of demand. When demand goes up, fees go up. That's just how it works. Like there's no magical, we're the low fee chain, right? That means we are the capacity exceeds demand chain. That's what it means to have low fees. When demand goes up, fees will go up, period. And if you're right that Solana is on this ascension, which, you know, great, we're long Solana, I'd love to see that. Fees will go up. That's normal. Every chain goes through that. At the end of the day, what I am arguing is that it is very hard for Solana to play the same role that the EVMs play because they're optimizing for a different thing. And to be clear, Anatoly is very clear about that. He's always been very clear about that. Yeah. That like, look, I'm not trying to be what Ethereum's trying to be. I'm trying to be something very different. I'm trying to build the NASDAQ on the blockchain, and everything that he is doing from an architectural, from a, you know, the point you were making about security and decentralization, I agree with you. In the very early days, I criticized Solana for lack of decentralization. I think Solana is very decentralized now. I think the development of Solana is not decentralized, and that's obvious to everybody. But that's true for every Alt-L1. No Alt-L1 has decentralized development, and that's fine. You know, whatever. They're startups. My view on Solana is not the problem with Solana is that it's not decentralized or it's not real. You know, it's not a real blockchain or whatever. There are people who make all sorts of criticisms about, you know, and I made some of them, and I think they're real, and I do have real concerns about the auditability and verifiability of what's happening on Solana. You can't run a live client. You can't verify the code. Blah blah blah. All that shit is real. They can eventually fix it. They haven't fixed it yet. But these are all solvable problems, right? Nothing that I described is beyond the pale of solving. But it is just true that Solana is optimizing for a different set of things than Ethereum and the EVMs are optimizing for. And that's very likely to lead them winning in different sectors than the EVMs, in which the EVMs are going to win. And you see it, like the market is telling you this, that you know, although DeFi is making a comeback on Solana, it is not as much as DeFi has made a comeback everywhere else. Right. So if you just look at the TVL recovery overall in crypto, Solana has recovered to something on the order of, you know, 1/10 of where it was in the FTX era. Whereas, you know, there's been tens of billions that have flowed into the rest of the crypto ecosystem and all the EVMs, because EVMs are safer. Now, obviously, there are a lot more hacks that we've seen in the EVM space. Large part of the reason for that is there's just a lot more shit to hack, right? Like instead of having 3 protocols of which, you know, the code is all poorly understood and it's all, you know, it's written in Rust and there's not as much tooling to be able to actually, you know, if you're a black hat and you want to go hack Solana, you know, we should more or less, you know, my view is that there's an efficient markets hypothesis around this stuff, is that probably even if you do hack stuff on Solana, it's hard to monetize a hack on Solana. You know, it's not as much liquidity. There's, you know, it's easier to choke things off. Like, I don't know. I more or less assume that there's, if you're a black hat and you're thinking about how to spend your time, there's also just so much low-hanging fruit. Who wants to learn a new language when there's already so many fish in the barrel you can shoot in EVM land? But if Solana really does become dominant, which it hasn't yet, and it may, if Solana really does become dominant, there will be a reckoning for all of the tech debt that has been incurred on the Solana side, and there's certainly a lot. Now they've been working on it, but I think there's certainly a lot, and I say that with eyes wide open. I'm investing in Solana anyway because I believe its utility for the use cases they're targeting is there. And I think that's one of the things in which we haven't talked about, which I think is actually perhaps the most interesting thing about Solana, is that no other chain, even Monad, even a lot of these other chains, nobody is trying to do as low latency as Solana. A big part of the reason for that is that Solana makes a lot of trade-offs around, the P2P architecture, the fact that there's one leader, the leader rotates immediately, there's no mempool, there's no Merkleization. A lot of these things allow you to move much faster in rotating who the leader is. So Solana's 400 millisecond block times. Nobody else is even close to that. If you're talking about stablecoin settlements, especially for traders, that is one of the things that I'm surprised has not already migrated to Solana, where the fastest way to move stablecoins from exchange A to exchange B, if you're doing like high frequency shit, is on Solana. Now, most people do it on Tron. Tron is the predominant way today that people actually move stablecoins from exchange A to exchange B if they want to move things quickly.
Well, because the only thing faster than a decentralized system with 400 millisecond latency is a centralized system, and so that actually kind of makes sense, right?
Well, no, but Tron is slower. Tron is like 2 second block. I think it's like 2 or 3 second block time.
Oh, is it really?
So Tron is actually an order of magnitude slower than Solana.
On the chain, it is. I actually don't know. I haven't looked at this, but on the chain, it certainly is. But are the exchanges honoring that, or are the exchanges doing stuff like, presumptive, closing the block? And they're like,
no. So actually, you pull this up. I think Kraken has their Kraken. They publish. Let me see here. Confirmation times.
Like I know the data. Chain. Yeah, I know the data on like all the volume is through Tron. But this might actually speak to, like, as you were talking through there, one thing I was thinking was like, I think part of the reason that I think it's not anywhere close to game over. I mean, it reminds me of like, Facebook versus MySpace in some senses, which is an overdone analogy, but I think there's a lesson here, which is MySpace had 80 million users when Facebook got started, like, and Facebook won, right? And so like these network effects, even at 80 million users, were not enough that something else couldn't overcome it. And so we're just such in early days here that I actually think a lot of the network effects are going to be driven by the killer apps. And I think that you could certainly imagine a situation where there's a killer app that emerges on Solana. Maybe it's Visa because of stablecoin settlement, right? They said that they're playing on Solana now, such that all of a sudden you get the next 100 million real users coming into that chain. And all of a sudden the network effects of like 25,000 developers on ETH and a couple $1 billion just gets overtaken in 12 months. Like, I don't think that's out of the question here. So like it's part of what, I mean, I think it was maybe Santi, your original question, but, I think that's one of the really challenging things in investing in this space is we're so early that the network effects, I think, as they are, I don't think they're insurmountable by any means. And so, like one thing, as Haseeb said earlier.
I mean, first of all, like every blockchain has anti-network effects. Perhaps Solana is the one that doesn't.
Yeah.
I mean, like that's the thing. Like I think network effects are largely misunderstood here, and I think someone like DYDX, Antonio, will tell you very quickly.
Yeah,
like this is why we moved to Cosmos. Now we haven't talked about Cosmos, but to your point of each, like where do you actually believe that we may achieve some degree of of network effects? Because every chain today has anti-network effects.
Yeah. So I don't know. I kind of think it's
I dispute that. It's not anti-network effects, right? It's bounded network effects. Bounded network effects, right? But that's true for Solana too. If Solana gets like 100 million people using it today,
Solana's going to need to improve Solana's going to need their version of 1559. They're going to end up needing Solana L2s. Like this is going to. I'm gonna pull us forward. I'm gonna pull us forward into the next topic because we spent an hour on this already, and it's actually a.
That was only one topic.
It's related. It's related to this, which is
before we move on, just one thing I want to close the loop on. I have it in front of me. The Kraken confirmation times per chain. Tron USDT on Tron is 2 minutes. Solana is 2 blocks. So basically a second to have it show up in your Kraken account.
Everyone thought this was going to be the cycle. This is the cycle where we put infrastructure behind us and we start talking about the big app and the consumer use case and millions of people. And here we are, and we just spent an hour talking about programming languages and the L1s again. So my question to you, maybe Avichal, I'd throw this to you, is Is this actually the cycle where we get the big use case and the big consumer thing? Or is this one more cycle, which is probably actually totally fine? Maybe it's not fine, but is this one more cycle of infrastructure?
Just
I
one more
think
cycle, bro.
Just one more cycle, but also it's like the
Haseeb
second.
just keeps pumping his monad
One more-
bags. He's
just
just like, one more cycle with infrastructure.
but
Please,
also-
bro, just give me one more cycle.
But
one more
also,
cycle. I
like, if
promise
I
I'll
were in
give
your
you
guys'
a
Okay,
real
here.
app.
Well,
If,
no, hold on. Well, I think it's a relevant conversation because Haseeb, you guys spend a lot of time in Asia.
Yeah.
The question is, are we going to, like Nervos type that didn't live up to its expectation, but are we going to see actually some sort of regional fragmentation, or is this too low level infra that it doesn't matter and we're just going to have a kind of this duopoly that you guys are both agreeing on?
No, basically no.
And
Yeah.
why is that? Like the tech depth just isn't there to like do the innovation that you need to really win at the base layer?
Yeah, I think if you're talking about ecosystems, definitely not, right? I mean, you can look at Binance Smart Chain and say, okay, well, this is like the China / emerging market / Binance distribution chain, which is true.
Yeah.
Polygon has huge penetration in India and Indonesia, and so it is obviously the case that there are certain chains that have higher geographical penetration in certain places. The idea that at equilibrium we're going to have a chain for China that's written from the ground up to be for China, I think we're way past that being a possibility. I think that's obviously absurd and it's not going to happen. The question of will there be sort of within the EVM ecosystem, will there be a layer 2 or a roll up or a application specific blockchain that is catered to a local application that's maybe in Malaysia they have this hot app and they are like, oh, we're going to roll it on L2 because it's too expensive for our users to be on mainnet or something. Yeah, totally. That might happen. In a sense, that's what Binance Smart Chain is. It's like, hey, Binance has a lot of users that no one else has, and they're going to let them play in their little walled garden. That is absolutely going to be a thing. But is somebody going to rewrite from the ground up this new blockchain that's going to be for China? No.
Avichal, let me alter my question a little bit, which is
Sure.
you guys sit in the investment seat.
Yeah.
No matter how good a consumer app is, most of them still don't have a token. So you guys aren't actually incentivized at this stage of where we're at in crypto to invest in that. So what gets us to like get over that infrastructure hump?
I actually think we are incentivized. I think that it kind of goes back to this idea of what is the catalyst for this stuff actually working long term. And I think if we're like in this constant cycle of let's build the next gen infrastructure, it just doesn't bring in enough people to actually use the thing. And until there's like fundamental utility, this stuff doesn't work. And so in some sense, it's kind of like the Bitcoiners went through this, I think, where you realize that if you just hold Bitcoin, that's important, but like there has to be lightning. Like you want the thing to like have flow. There needs to be usage. There needs to be like businesses integrating with it. You need to have Square doing its thing, and so this ecosystem matters. You need to incentivize the devs to keep working on it. You can't just have a chain that's dead because the core devs don't want to work on it. So, like almost from like an ecosystem perspective, if you think of it as a portfolio, I think there's a strong argument that if investors are not investing in things beyond infrastructure, the infrastructure is useless. Like you have to be investing in the ecosystem, if only, and this is not the reason to do it, but I'm saying if only to make sure that your infrastructure investments are actually used. They have to be apps, right? Now, the way we think about it is actually beyond that, which is that the real end case here, the end state that we would like to get to, is that people don't even mention the word crypto, right? It's just the way we don't mention the word mobile. It's just an app. It's just you solve a problem. I'm taking a photo. I need to like order groceries. I need to get a car. Like you just think of the thing that you need to do. And some of those things will use cryptography. Like I think the solution to a lot of the AI deepfake stuff is a cryptographic solution. It's like the White House needs to attest that they're the ones who took this video. They need to publish that cryptographic signature somewhere into an open database that anybody can read from. That cannot be corrupted easily, based on some standard that everybody agrees to. And like, what do you know? Like that's literally what we've created here, right? Or we have portfolio company will never have a token. It's a company called Spruce. Spruce now powers the California DMV's app. So like your California DMV, your driver's license in the state of California on your phone is powered by Spruce. Spruce originally started as sign in with Ethereum. So it's literally the same public private key cryptography ported for this like government use case. And now your driver's license in California and actually another state is powered by that same technology. That's real utility, right? And so I think like for this stuff to, as a technology to get out into the market and power healthcare use cases and government use cases and real world use cases, I think is really, really important. And then between sort of the infrastructure and these like apps that will never have a token and may never even write out to a chain, there's this huge white space of stuff that's kind of messy and in the middle. And so you look at something like an NFT marketplace and you say, well, like that trades NFTs, that kind of has some NFT L1 stuff. Maybe it could be its own L2. Maybe it needs gas. Maybe it doesn't. Should it have its own loyalty points? Should it have its own token? And so I think there's this like messy middle right now, especially around things like NFTs, creators, social, um, which I think will probably have both. I think it will have like an end user utility where people just want to use the thing for the thing, but it's going to be crypto native. It'll take advantage of things like cryptography, L1s, gas, loyalty points, marketplace dynamics, bonding curves. Like there are these like really interesting innovations that will get baked into those applications. You won't call it a crypto application. It'll just be a marketplace that does a thing. Um, and that middle ground I think is really interesting right now. I think it's entirely possible that in this next cycle, 2 or 3 people kind of stumble into some really interesting stuff there. And so you're starting to see the very early beginnings of that. Like, so to me, something like Friend Tech feels to me like the first sort of proto social network, or Farcaster working. It's sort of starting to feel like, we're in that like 2002 era of social. So like this is even a little bit before my time at Stanford, but at Stanford there was a social network that was launched called Club Nexus. It was started by this guy Orkut, and then Orkut went on to work at Google and started the social network called Orkut that took off in like Brazil and India. It was bigger than MySpace and Facebook in some of these markets for a long time. But they were sort of like proto networks. They didn't have like a news feed. They didn't have like a lot of what we would look at as a social network today. And it took a couple of years of exploration. I think we're in that window now. I think like somewhere in the next 3 years, somebody will figure out like a social app, for example, that really takes advantage of the native social breakthroughs, the social innovations here. And that might be the thing that goes really viral. Or gaming, right? There's how many like great teams that actually have gaming experience have now entered the space and have been hacking for the last 2 years. Like the last gen games that we had, they were fine, but they were kind of, like the play to earn stuff. Most of it was because people were grinding to get the tokens, not because they wanted to play the game. And I think this cycle, you might actually get some games that are fun to play. Or, NFTs themselves, like, in this bear market, people, I don't know how closely people have been paying attention, but like Nike's been shipping, LVMH did a drop. Like these big brands have been continuing to sort of push forward with their teams because the people who understand luxury goods and understand social signaling understand that this is actually digital social signaling. And that's a huge market. Like literally the richest man in the world is Elon Musk. The second richest man in the world, Bernard Arnault, runs LVMH. And their business model, if you look at it, is to take capital and to turn it into social capital. Like that's literally when you buy, Louis Vuitton handbag, what are you doing? You're buying social capital. You're signaling to all the other primates that you have excess capital. And that clearly has to be digital, right? Like, and this is like a really deeply ingrained human behavior. And what it reminds me of is like in the early days of the internet, there used to be these graphs that were like amount of time spent on newspapers, amount of time spent on the internet, dollars spent on newspapers, dollars spent on the internet. And you're like, wait, that just has to fix itself. Like the dollars have to go where the people are. And I think we're in a similar state right now with digital goods spending and luxury goods spending. Like all of the luxury goods spending is offline and it has to move online, and NFTs are the vehicles to do that. Like right now we can't see our shoes. Why does it make sense for me to buy $1,000 shoes? That makes no sense. Right? You can't see what's on my wrist. Like it doesn't make sense for me to buy a $20,000 watch. All of that spending, all of those billions of dollars to spend, I think move online. So I think we have these like categories.
So does that mean that you have a $20,000 hat?
No, yeah,
that's priceless.
No,
priceless.
Yeah, no, that's actually a good
took
insight.
off his watch. Yeah.
No, but that's a really good insight.
Hey
right?
man, you're talking about watches. I like watches, man. What are you talking about? Like
crypto people, well, we can have.
I mean, probably, yeah.
Point being though, I think like we have some really interesting candidates beyond the infrastructure now, whether it's social and sort of proto-social networks, NFTs as social networks, NFTs for social signaling, these other applications that may or may not actually have, on-chain influence. Like we're starting to, I think see some proto applications here that I think could actually break out. And you only really need one of them. Like, you get one or two and all of a sudden everybody will start copying it and mimicking and building on top of it. And you're off to the races.
I completely agree with you on the NFT side. I love the point you brought up about Elon Musk, which is also something that just occurred to me. Yeah. Is that okay? Richest man in the world, Elon Musk. Second richest man is the creator of LVMH. LVMH is doing NFT drops, and surely he must recognize that the second richest man in the world must recognize that the richest man in the world does not wear LVMH. and doesn't signal that way.
Yeah, that's right.
Doesn't signal in the way that like the old world and like that massive market
Yeah.
into which he has locked in. Elon Musk signals in a totally different kind of way.
Yep.
And that is much more the way that crypto natives signal and think about social
Yeah.
status and value. And that's why I'm also bullish on NFTs. And I think they will come back and continue metamorphosing. However, I am not bullish generally on crypto consumer and crypto social in a broader sense. NFTs, I think I kind of bucket in more with financialization of status. And, you know, I think the further away you get into the outer reaches, farther away from money, the less crypto holds valence and the less power it really has to actually create new, more interesting products or things. The closer you are to that core, and I think NFTs are actually still pretty close to that core of being about money and value and status. The more valence I think crypto has and the more power it has to have real staying power.
I think we always want validation into our interests. And, you know, if you're collecting art, wine, watches, whatever it is, or digital, translate that and include digital first, then it doesn't really matter. You want validation. Crypto is a really good mechanism to find price discovery on these tail end of things, much better than the real world because you drive more liquidity. The question I ask is, so music NFTs is an example, or games, as we saw DeFi with the veneer gaming, which was like farming yams was better than playing Axie. And no one can tell me otherwise because I had a lot of fun farming in DeFi summer until prices collapsed or you had hacks. Nonetheless, are there instances where, as you talk about like moving outside of these like concentric circles, like the closer are your financialization, the better? Are you guys like not investing in things where you think that by introducing financialization or more of it in a more real-time manner, it actually detracts from the user experience? So like gaming is an example, right? If you're playing World of Warcraft, hey, maybe you played it and then you're like, whoa, I can actually sell these things. But if it's constant real time, it's distracting, it's noise. And so it degrades from the user experience. The same way that perhaps artists with music NFTs realize, which is like, wait a minute, my fan base all of a sudden might call me because the price of the NFT collapsed 90%. That's not good because it introduces a vector that I don't like. So I am curious if one, your views on gaming, on music, and like some of these other things that are trying to overly perhaps financialize it and detract from the consumer experience. Thoughts there?
There are a lot of things in the range of human experience that shouldn't be intertwined with money. Like if you give me a gift and I give you back a gift and I point out to you that like, well, my gift was worth slightly more than your gift. It somewhat destroys what we were doing with the gift giving, right? If I sit down with you and I'm like, hey, Santi, I know you're going through a tough time. I really want to support you. And look, you know, this means a lot to me because my time is extremely valuable. I make, you know, whatever huge amounts of money per hour and I'm foregoing that to spend this time with you. You would kind of be like, wow, what a fucking dick. Like that kind of ruined what I thought we were happening here. So even though these things might be facially true, it's actually important for a lot of the things that we do that they not be directly tied to money because there are different kinds of things that we do as human beings that are not about money. And I think it's obviously true that for a lot of games, it does cheapen the experience or contort the experience, distort the experience. If we start making something that's about, you know, me building a community and bettering myself and like, you know, really building something and getting very excited about creativity with, well, how much more money am I making per hour if I keep leveling up my character or doing this or doing that? Like, I don't want that to be the experience that I have when I'm, you know, playing Elden Ring or whatever. However, there are a lot of games that are some of the oldest games in history that are directly about money, right? So some of those popular games in the world are games that people play Mahjong. It's one of the most popular games in Asia. I'm in Asia right now, right? People play Mahjong all day long. And Mahjong is played for money. People gamble over Mahjong. You know, people gamble over poker. They gamble over all sorts of games that have very, very deep valence. But the way in which the game is played and the kind of game that it is distorted by the gravitational field that money applies to what it touches. And so I think it requires some thoughtfulness in order to figure out how does a game interact with money in a way that makes both of them fun and doesn't cheapen the game and also doesn't, you know, kind of detract from the monetary game that is also happening underneath it. I think we're still very early in exploring that intersection of, you know, if you think about it, poker's a good game, I think. Obviously, it's very popular. It continues to be popular. It's been popular for a very long time. There are very few games that have been invented in the last 100 years that are like poker. It's kind of strange that there's been so little kind of successful innovation in, there are variations of poker, but they're all still, 52 cards, people sitting around a table. There's nothing internet native. There's nothing like in a digital space. There's nothing like, we haven't really figured out, why is it? There must be a richer intersection between money and risk and gaming and fun and worlds. And there must be more there than we've currently explored. And that's where I think the most fertile intersection of crypto and gaming probably lives. I don't think it's going to be, oh, well, your sword can be exported from this game to that game. Like that, that's a lot of what people talked about in sort of V1 of when people thought about crypto and gaming. I think it's going to be something more complex than that when crypto gaming really starts to work in a deep way. Until then, it's been a lot of just kind of Ponzi schemes disguised as games, where you kind of work through the game in order to play the Ponzi scheme. And look, Ponzi schemes are fun, right? They're also one of the oldest forms of gaming in the world. Is bubbles and Ponzi schemes are naturally. I mean, that's what you could argue. That's what a meme coin is. A meme coin is a bubble as a game, and we all play the game of when do you get in the bubble? Did you pick the right bubble? Did you exit at the right time? It's a fun game, but it's a different kind of game than I think what's going to end up working in the intersection of crypto and gaming.
Well, I will say, I think that, so from an investment perspective, it's something we're very cognizant of. I think we don't want to create incentives for people to cheapen the thing. It has to be additive. I agree with a lot of what Haseeb was saying. I think though, and I also agree that I think the intersection of what crypto can do natively in either games or NFTs or social experiences is very underexplored right now. And in part, it is actually going back to the infrastructure thing. I think the infrastructure just wasn't ready. Like you couldn't actually have high throughput, like what DYDX had to do over the last 2 years to get to the app chain that they built. Like, it just wasn't possible to do that in 2016, 2017. It took a lot of infrastructure building over the last 5 years to get to this point. And actually, if you look at the history of technology, people talk about these kind of like 10-year cycles. And there's this turn of phrase, I think it might be a Bill Gates phrase, that's, people overestimate what's possible over 2 years and underestimate over 10, going back to what you were saying before, Santi. And we're like 5 years into the wave now, right? From, if you think about the 17 ICO bubble to now, like 5 or 6 years in. And I think only now has the infrastructure gotten good enough, which is why I sort of think that if you think of these things on a roughly 10-year cycle, somewhere over the next like 2 or 3 years, somebody will stumble into some killer apps at the intersection of these things that will feel crypto native, and really take advantage of the technology, because it's now possible to do that. Like, who was it? The Xerox Park guys that were doing the ZK game. Was that who that was? Was it Park Labs?
Mm-hmm.
Yeah. Like that was a really early example of like people trying to take ZK proofs and do something novel as a game with it. And I think we're going to see a lot more experimentation now that the tooling has actually gotten good and useful. And so we're just at the very beginning of that. Now, I think that the unfortunate reality is that when you hand a bunch of people technology and tooling, they will tap into these really potentially negative feedback loops that exist in the human brain. And so you could certainly get people that build things that are that take advantage of these loops and are potentially net negative on society even, but are extremely addictive and have extremely good feedback loops. And so I think, like as an investor, it's something we think about a lot. Like, are we actually building? You don't want to invest in a thing that, like, you don't want to invest in a literal casino. Like we don't, at least. Right. And what we want to do is invest in markets that are helping price discovery on real fundamental utility happening. Like if we can get the capital markets all over the world to have access to a better financial product in the form of reinsurance. Now the reinsurer, which is creating a really net productive thing in the GDP, can actually go like fund that activity with a lower cost of capital, because there's all these people that will give them money at a lower cost because they don't otherwise have access to good financial products. Like that's a net positive use of capital on chain. Right. But I think it's going to happen. Like it's unfortunate, but it's inevitable. Like when you hand a bunch of people a bunch of technology, some of it is going to end up getting combined in a way that is going to take advantage of people and sort of exploit people. So I almost feel like at the market level, it's unavoidable that happens.
So
Yeah.
what do you have against casinos? What's wrong with casinos?
I think that, well, the challenge with casinos is that there's like there's a good way to run it and there's a not so great way to run it. The good way to run it is that it's kind of as sort of the similar to the meme coin thing, right? Which is like, if everybody knows the game that they're playing, it's all good. Like we're all playing this game of money chicken. I put in $50. Like let's play chicken, and like whoever takes the money out last loses, right? So the problem comes, I think, when and it's a form of entertainment, right? And it's like, yeah, I was going to spend like I now have to spend $50 at the movies. Great, this is better. The problem comes when you have a bunch of market participants that don't realize they're playing a game or are unable to play the game in a way that is net productive to their life. And that's the risk that you run when the motive for the existence of the entity is to create more money, because the easiest path to creating more money is to take advantage of those people who are least likely able to understand that there's a game, and they shouldn't like put all their money into the game because it's a zero sum game. And that's where I think like bad actors can take advantage of that, because there are a lot of people out there that don't understand what's happening. I mean, something I worry about. I was actually talking to a set of founders just yesterday about, you have to be really, like one of the really interesting things with exchanges is the early people that come into this part of the market cycle often do understand that there's a game that's being played. A lot of the people who come in like late cycle don't understand the game that's being played. But the saving grace often has been that you've denominated these other games effectively, like if you think of meme coins as a game, that you've often denominated them in assets like BTC or ETH. And so you've inadvertently, when you take any profit or you've ended up with gas or dust or whatever, you've ended up with an asset that has actually store value kind of characteristics and has appreciated over time. And so the saving grace for a lot of people is maybe they came for the game and then they ended up with a stack of chips at the end of it that was like, they're down 80%. And then they just ended up with some BTC, which when they looked back 3 years later, they're like, oh, whoa, I'm up on my Bitcoin. Like, what happened? Right. And so there's this like weird saving grace where it's like a lot of people play the game. They don't realize they're playing the game, but then they end up getting their butt saved because not the game that they were playing, but the other thing kind of saved their butt. And that actually, I think, ended up saving the exchanges in a lot of ways, because that prevented the exchanges from burning all their users out. Like if you imagine a situation where like everybody plays the meme coin game and most people lose money, because that's what's going to happen, you actually will just burn all your users. Like there's no reason for people to come back because they just like lose faith in the whole system.
Haseeb, give me the counter on meme coins.
Are you pro meme coins?
Well, I've been thinking about it a lot because we've been digging into a lot of the data of what's happening on certain of these super high engagement chains. Like if you look on Dex Screener and you just look at where are most of the meme coins trading, vast majority of them are on Solana, and that's actually where a lot of the retail engagement. You look at what are all the transactions on Solana, what are all these people doing? Mostly they're trading meme coins, and when I talk to people who are like really young, one thing I always try to track is like basically what's the current young person's hustle, that they're like sort of one step ahead of older, more esteemed people who have real careers, but they're making a lot of money. What's the thing that they're doing? So like Santi, in 2020, it was DeFi summer and it was like yield farming and all this other stuff. And then a year later, it was NFT trading. And then it was, it was airdrop farming, and, that's kind of getting competed out. And so now it's trading meme coins. And there's just like this insane churn of meme coins where basically every couple of days there's a new meme coin. And these guys who are like, 17, 18, 19, who just like are building up their bankroll, they're trading meme coins and they're looking at the alpha and they're looking at the signals. They're seeing which one's coming up when, and the turnover on these is crazy high. And that's a lot of what's driving the activity on Solana. If it has a hat, it has more longevity. Yes, that's
true.
That's right. But what's interesting? So the thing that I was asking myself, look at this, because I'm a fucking an old fart and I don't do any of this shit. So I'm like trying to philosophize about meme coins, obviously. So the question I'm asking myself is like, okay, this is the game. This is the game on Solana. It's a game on, obviously there are meme coins everywhere, but Solana seems to be where most of them today are getting launched. Like people aren't launching them as much on Ethereum these days. And a large part of the reason why they're not is because Solana fees are so low. And so, I was reading a Reddit post about this guy who deposited, like he gave his little brother $10 to go trade on Solana, and his brother's made like all these trades, like an insane amount of meme coins he's been going in and out of, and now he has $20. It's like, wow, he turned $10 into 20. Like that's people are this is the game on Solana. You can't do this on any other chain, right? You can't trade around $10 on any other chain. So now the thing that I'm thinking about this game is that this game doesn't seem sustainable to have this high churn of meme coins, right? Now, why do I say that? The reason why I say that is to Avichal's point. This is a game that's rigged against you. There was a story recently about Zach XBT, talking a bunch of shit about meme coins, and people got mad at him. Normally, he's like the crypto Twitter hero, but then he kind of became the villain because people are like, oh, why are you shitting on meme coins? And the thing he said is like, look, most meme coins are rug pulls. And he's right, is that anybody who's launching a fly-by-night meme coin overnight, they are giving themselves a little bit of supply, pumping it as a meme coin. It dumps 2 days later, and they move on to the next one. Everyone is fine with the creator of the meme coin basically taking a big tax. in order for them to create the game, the next casino game that we're all going to play, to basically do the next Ponzi, right? Or the next, kind of game of chicken, essentially, as you described it, Avichal. I think that's right. I think that's the right mental model for what meme coins are, is we're all kind of playing this game of chicken. There's a new round that starts every couple days, and you get to play the new meme coin, and then we all move on to the next one. And it's all a function of what's doing the most volume and where you think you are in the hype cycle for this new meme coin. If that's the game that's being played, if you think about casinos, right? Going back to casinos, slot machines are the most popular things in casinos. They make the most money by far. They're insanely profitable. And they are perhaps one of the most optimized computer programs in human existence. What they are optimized for is to maximally extract money from people over unit time. And how do you maximally extract money over unit time? Well, there's kind of two things you're optimizing for. One is how much money you're getting per hour, and churn. You're minimizing churn, maximizing money per hour, and there's some complex function you're optimizing to make sure that you keep people there, you have the right variable ratio reward function, but you're not taking too much money so they don't feel like they're losing, enough bells and whistles in the meantime, right? That is what meme coins should be doing if they want to be sustainable. They should be trying to optimize for long-term longevity and minimizing churn. But obviously they're not going to do that because there's not a single actor in the meme coin game. There's all these different people launching meme coins and trying to get their meme coin to be front page so they can make some money from, getting in and out of their own meme coin. And so it's just going to be too extractive. People are going to lose too much money over a long enough period of time, such that now this is not true for meme coins with longevity. So I think Dogecoin has infinite longevity. People will be able to play that game forever because it's not extractive at all. There is nobody who's making money from you, except maybe exchanges, from you trading Doge. And maybe with, dog with hat, there's nobody who's maybe making money from you at this point. But for this meme coin loop of there's a new meme coin coming out every other day, this game doesn't feel like it's sustainable. And I think this game, if you think about this kind of random walk of like, what's the fashion that people are doing? Where before a year and a half ago, it was trading NFTs. There's a new NFT collection every single day that people were jumping in and out of. And now it's moved on to meme coins. The question I was asking myself is this going to stay? And the answer to my mind, if you look at this, is probably no. I think in 2 years, there will be a new thing that people will be doing that's not meme coins, because meme coins, as they are made today, is not sustainable. I think the big meme coins will survive, but this crazy rotation of meme coin into meme coin, I don't think this will be the thing that people are still doing in 2 years for that reason. That's my meme coin thesis. I was thinking about that a lot yesterday.
Yeah. I generally agree, though I think these things will have a lot of longevity. I think I suspect it's not 2 years, because I think I basically agree with the unit economic math there, which is like it net burns people out and it's net extractive. But I think there's a lot more people who have not yet been burned. And so I think like the size of the pool of people to come in to want to play the game is just so large that I suspect the meme coin.
But this isn't unique to this cycle. I mean, like 2021, like I remember playing, I opted into the game, like Goblin Town NFT, or like Frank NFT, like that's right. That was no different.
The point they're making is not that there won't be other bubbles. It's that the game will change. The meta will change.
Oh, yeah.
It won't be meme coins anymore, right? Last cycle, it wasn't meme coins. It was meme NFTs, essentially.
Yeah.
Well, I mean, there's like all
no, it was still meme coins. It was like Sif with, like, what is it, Shiba Moon?
Yeah,
coin.
Safe Moon.
Like at the end of the day, like the way, no. Let's just put it in perspective. Like in terms of aggregate liquidity, volume, interest, like meme coins have always been like at the center of every cycle in crypto. Perhaps after you had like smart contracting platforms that enabled this stuff. But like the way I see it is you can invest in Maker, which is probably the extreme of boring, not sexy, doesn't move, but and the other extreme, like meme coins, and then like NFTs that are like really cool but not as illiquid, and so there's a tax to coming in and out. And meme coins sit slightly more closer to NFTs, which is and really financialized, and so it's fun. It has like emotional cachet but the deep liquidity that like perhaps an NFT is not going to have. So if you're going to buy something, probably it's going to be a meme coin, not necessarily an NFT, because there's like unit bias, and like 10,000 collections like tend to be really pricing out a bunch of people in the market. Whereas you're not going to buy Maker because Maker is just the pet rock that doesn't move.
Yeah, I completely agree with you, but I don't think the operating variable there is liquidity. I think it's volatility. Meme coins are super volatile. When people buy meme coins, what's their psychology? The answer to my mind is that they're buying lottery tickets.
Yep.
and they see the Reddit post, they see the Twitter post, they see whatever, like the friend of a friend of a friend who turned, $1,000 into $1 million. That is what keeps them playing and buying the next meme coin to think maybe this one is going to be the next Shiba Inu or the next Dogecoin. And that dynamic could very easily move to something else, whatever is the next iteration. And maybe it's something that right now we can't quite imagine, because maybe it's something we're going to think is so stupid that why we want to imagine it. But that will be the thing that has this crazy volatility and the ups and downs and the, mints the 1000x returns. And then people will start doing that, even if it has terrible liquidity or if it has super bad slippage. They'll say, whatever, that's not why, people are not buying lottery tickets based on their understanding of the payouts and the EV of doing that. They have no idea. Most people don't even check to see how much they're losing the average time they pull a slot machine.
Yeah.
They just feel it over time through their own churn.
Yeah, I do think the only thing I would add there, I generally agree with a lot of that. I think because I was also thinking about this week, is like, I think it's turned out to be the case that the saving grace has been that the base units of account of these things, which have been Bitcoin and ETH historically, have appreciated to such a degree that even if you lost a bunch of money on the meme coin side, you did okay, because the base unit that you held has appreciated so significantly, which kept you in the game, which allowed you to sort of pay the tuition. It's almost like a tuition cost that a lot of people pay. And then they realize the game that they're playing. And at some point I worry that like that cycle can't hold anymore, and that you can actually like burn a lot of people who don't realize there's a game that's being played, that they're not playing a game. They think they're investing. And that's a real challenge, I think.
I see it kind of differently.
The worst game that was played was Terra, disguised as a stable coin. People didn't know the game they were playing. The size of the door stayed the same. The number of people in the room increased by orders of magnitude. When everyone tried to get out, it was a problem. And that has burned, and that's probably the biggest hurdle, because if you go look at the R Reddit forum, Wall Street Bets, people still talk about that, and really burned. Which leads us to, we need to build a really beautiful consumer applications that are not as destructive, pure casinos, to pull in these people in, hopefully this cycle.
Yeah, no, you had a thought?
I actually like Haseeb's framework for this, which is you can kind of opt in or opt out to these games. It's actually kind of how I think of casinos, or like Vegas, basically. Like, I'm not a regular of Vegas, but once in a blue moon, I like to go with some friends to Vegas. I'm like, I know I'm going to lose a bunch of money, but I'm going to opt in for the entertainment, basically. And like, that's how I treated, honestly, like the meme NFTs in 2021. That's how I treat, like, I was like, I'm not opting into these meme coins. And I saw like something like Blur, and I'm like, okay, let me get a little like shots of dopamine in me. Like, let me play this game for a little bit because it's fun. And then I see like some other ones, I'm like, I'm not opting into this just because I don't have the time or something. And I don't know, I actually kind of like, it's like sports betting or casinos. It's like, I'll probably lose money on this, but like, I don't know, it's kind of tokenized attention and tokenized fun. And
no, they definitely play a role, and I think it's just entertainment. And I think we shouldn't police how people want to like spend their money in terms of entertainment. It's just that I think that sort of as investors or as people who are trying to build the ecosystem, the only way to make it sustainable is to make sure that there's enough high utility. Like, if we ended up in a world where it's 100% meme coins and that's the only thing that happens on Solana or Ethereum, it's over. Like, this is
what I think is really bad for the industry is when actually folks maybe in like your guys' seat, like some of the like leading investors or whatever you want to, kind of title you want to put on you guys. Like, there's some venture folks who are like people who are deemed by the crypto Twitter to be like the good investors in crypto are pumping these meme coins. Then they basically go from entertainment to like retail thinking they're a good investment. And that's when people get burned. So, Haseeb, man, you came to this episode saying you're tired. Didn't seem too tired.
Avichal just gets me going when we start disagreeing on shit.
A couple of Solana
But no,
jabs
I look.
Conti and
actually Solana really
got you going this time.
That's what did it. It always does.
Yeah, no, guys, I really enjoyed this conversation. I got to run soon, but Santi, I love your point about Terra, in that the thing that I got to give respect to meme coins on is that they are honest. And nobody goes into a meme coin thinking that they're making a sound financial investment. They know they're playing a game.
Oh, I totally disagree. I'm glad we're ending on a disagreement, Haseeb.
Okay, good. But like, I think people who are buying these meme coins, they understand that they're buying lottery tickets because they see the thing happening around them. And people come into casinos and they also understand that they're not going to be able to trick the slot machine, but they might think that they're going to win, and they might think they're lucky, and that's okay. That is entertainment. It's the oldest form of entertainment. Human beings have been doing this forever, and even when you make it illegal, they still do it because this is just a lot of what drives our psychology. It kind of, you can sort of back propagate what makes humans have fun, and the answer is risk. Risk is one of those things for a lot of people, not everybody, but for a lot of people that taps into the deepest form of engagement and excitement. And I think that's okay as long as people know what they're doing. But Terra was not an example of that. And there are many cases where there are basically these kinds of games of chicken that are disguised as something else. And I think those are very destructive. And I think Axie Infinity was one of these. I think Terra was one of these. And I think there are others that, you know, I'm sometimes in the habit of calling out. But at the end of the day, you know, my issue with meme coins is not so much that they're bad for the world. I think they're fine as long as, you know, the people who are buying meme coins are the people who want to buy meme coins. But rather that, because like I said, there aren't repeat players. It's a new guy every day launching the next meme coin. It's better, I think, if you have repeat players, which I don't know how you would do that, but maybe, you know, like fan coins or some of these other kinds of things are more akin to that, or no players at all, which is the case for something like Dogecoin or Shiba Inu or some of these more like truly decentralized meme coins that are out there.
Yeah, I think that's a good stopping place. I have a feeling this won't be the last.
There's a lot of things that
yeah.
And I mean,
Yeah.
I suspect this episode is also going to be one of the most liked. So if I think there's so many things that we didn't get to cover that it was on my list, like Bitcoin L2s, activity in Bitcoin, you know, and so many other things that I want to get your thoughts on. Always a treat having you guys on. App chain stuff. Yeah. Good to see you guys. Thanks for coming on.
Yeah. Appreciate you guys.
Always.
Be well.
All right, guys. Take care. Bye.
Hey everyone, Jason here. Thank you so much for watching today's episode. Wanted to take a quick second to thank today's title sponsor, Arbitrum. We know you are tired of on-chain experiences that have unaffordable fees and frustrating transaction speeds, and that's why we partnered with Arbitrum. You can experience frictionless trades, lightning speed, and lag-free transactions, all for pennies per transaction. Explore Arbitrum's expanding ecosystem at portal.arbitrum.io. That's portal.arbitrum.io. See you for the next episode. Hey everyone, thank you so much for watching today's episode. Really hope you enjoyed it. We wanted to take a second to just remind you about our upcoming Digital Asset Summit in London, March 18th to 20th. Santi and I got your back. Seats are limited. If you heard it earlier in the podcast, there's a little competition running at Blockworks to see who can drive the most number of tickets. So when you register for the Digital Asset Summit, make sure you use our code. See you in London.